On July 28, 1914, while Europe's newspapers still assured readers that cooler heads would prevail, a very different reality was unfolding behind locked mahogany doors in London, Paris, Berlin, and Vienna. In smoke-filled boardrooms cluttered with bond tables, gold flow charts, and emergency credit projections, Europe's most powerful bankers had already reached a conclusion more chilling than any military telegram. War wasn't a possibility. War was an opportunity. Within days of Austria-Hungary's ultimatum to Serbia, before most politicians even grasped the danger spiraling through the continent, the financial elite understood something the public didn't. A continental war would trigger the largest boom in government borrowing, bond issuance, and emergency monetary expansion in modern history. The numbers were already there, written in gold withdrawals, collapsing credit markets, and frantic diplomatic cables that arrived at central banks hours before they reached foreign ministries. And while millions across Europe prayed desperately for peace, the continent's bankers quietly positioned themselves to profit from the coming catastrophe. The Reichsbank, Berlin, July 28, 1914, 11:47 p.m. The conference room on the third floor of the Reichsbank was thick with cigar smoke and tension. Gas lamps cast long shadows across mahogany tables stacked with telegrams, ledgers, and hastily scrawled calculations. Outside, Berlin's summer night was warm and ordinary. Inside, 12 men in dark suits studied documents that told a story the German public wouldn't understand for weeks. Rudolf Havenstein, president of the Reichsbank, sat at the head of the table, his fingers steepled beneath his chin. Before him lay 3 separate reports: gold reserve flows from the past 48 hours, an analysis of Austrian bond prices, and a confidential memorandum from the London correspondent of Deutsche Bank. He had read them twice. The conclusion was inescapable. "Gentlemen," Havenstein said quietly, breaking the silence that had settled over the room like a funeral shroud, "the markets have already decided. Europe is going to war." No one contradicted him. Around the table, the most powerful banking minds in Germany, representatives from Deutsche Bank, Dresdner Bank, the Diskontogesellschaft, had spent the last 6 hours reviewing the same data. They had tracked gold movements across borders, analyzed the sudden collapse of Serbian and Russian securities, monitored the Bank of England's emergency liquidity measures, and calculated the capacity of European governments to finance military mobilization. The numbers told a story more accurate than any diplomatic assessment. Franz von Mendelssohn, a senior partner at the banking house that bore his family name, leaned forward. "Austria's gold reserves have fallen by 94 million krone in the last 10 days, he said, his voice measured and clinical. "Russia has suspended gold convertibility at regional banks. The Paris Bourse saw a 12% drop in Eastern European securities on Monday alone. These are not the movements of markets expecting peace, Herr Havenstein." "No," Havenstein agreed. "These are the movements of markets preparing for total war." What made the moment so chilling wasn't the prediction itself. Many politicians and generals sensed the drift toward conflict. What distinguished this gathering was the precision of their understanding and the speed of their response. While diplomats still debated the wording of ultimatums and generals pored over mobilization timetables, Europe's bankers had already calculated the financial mechanics of the coming disaster with cold accuracy. They knew how much governments would need to borrow. They knew which bonds would survive and which would collapse. They knew that the gold standard, that pillar of European monetary stability, was about to fracture under the weight of competing national interests. And most importantly, they knew that institutions positioned correctly, institutions like theirs, would emerge from the carnage wealthier and more powerful than ever before. Havenstein stood, walking to the window overlooking Jägerstrasse. Below, Berlin slept, unaware. "The Kaiser will need financing within days of mobilization," he said. "War bonds, emergency notes. We must be prepared to extend credit on a scale this nation has never contemplated. What volume are we discussing? Asked a younger banker from Dresdner. Havenstein turned back to the room. Initial estimates suggest 5 billion marks in the first 3 months, perhaps 15 billion by year's end. The figure hung in the air. In peacetime, such numbers would have been incomprehensible. In war, they represented opportunity. And the interest rate? Someone asked. The government will pay what we require, Havenstein replied simply. They will have no alternative. This was the hidden mechanism of modern warfare that the public never understood. Armies marched on credit as much as they marched on roads. Guns, uniforms, artillery shells, transport, food, all required immediate payment in an economy suddenly stripped of normal commerce. Governments had only 2 options: raise money through taxation, which took months and risked political rebellion, or borrow from banks at interest rates that made financiers rich while nations bled. The men in that room knew which option their governments would choose. They had already begun drafting the terms. 6 weeks earlier. Vienna, June 15, 1914. On the surface, Europe that summer felt stable. The Balkan Wars had ended. The great powers maintained their alliances, but showed no appetite for conflict. In Vienna's elegant cafes, intellectuals debated philosophy and art. In London's financial district, bankers discussed railroad investments in Argentina and mining ventures in South Africa. The assassination of Archduke Franz Ferdinand on June 28th seemed at first like another tragedy in the volatile. Balkans, shocking, but not necessarily catastrophic. But for those who understood how money moved through Europe's veins, warning signs appeared weeks before Sarajevo. Karl Urban, a senior analyst at the Österreichische Länderbank, noticed it first in mid-June. A subtle but unmistakable acceleration in gold withdrawals from Austrian banks by foreign depositors. The amounts weren't alarming individually, a few 100,000 krone here, 1,000,000 there, but the pattern was unprecedented. French investors were quietly liquidating positions. Italian commercial accounts were shifting assets to Milan and Rome. Even normally stable Swiss depositors were requesting transfers. "Someone knows something we don't," Urban told his colleagues over lunch at the Café Central on June 18th. "This isn't normal portfolio adjustment. This is preparation." He was right, though he didn't yet understand for what. Throughout June, a silent financial current was building beneath Europe's peaceful surface. It manifested in dozens of small signals that, individually, seemed innocuous, but collectively revealed a system under stress. In Paris, the Comptoir National des Comptes quietly restricted credit to its Eastern European branches. The official explanation cited routine prudential measures. The real reason, discussed only in closed meetings, was concern about political instability in the Balkans and Russia's aggressive military expansion. In London, Lloyd's of London began increasing insurance premiums on shipping routes through the Eastern Mediterranean and the Black Sea. The adjustments were modest, a few percentage points, but they reflected actuarial calculations about rising geopolitical risk that underwriters couldn't ignore. In St. Petersburg, Russia's state bank watched with growing alarm as domestic gold reserves plateaued despite strong export revenues. Where was the gold going? Private hoarding, mostly. Wealthy Russians converting paper rubles into portable wealth, a classic sign of diminished confidence in political stability. These movements weren't coordinated, no conspiracy linked them, but they revealed something more fundamental. Europe's financial system, evolved over decades of relative peace and expanding trade, was extraordinarily sensitive to political risk. And that system was beginning to send distress signals. The week after Sarajevo, June 29th, July 5th, 1914, the assassination changed everything, though not immediately in the way most people expected. For the first few days, European markets barely reacted. Archduke Franz Ferdinand wasn't particularly popular, even in Austria-Hungary. His death seemed unlikely to trigger a major crisis. But bankers saw what politicians missed. Austria-Hungary would have to respond forcefully or risk looking weak in the Balkans, where Serbian nationalism threatened the empire's southern territories. And any forceful Austrian response would activate Russia's alliance with Serbia, which would trigger Germany's alliance with Austria, which would activate France's alliance with Russia, which would concern Britain about the balance of power. The alliance system, designed to deter war through mutual assurance, had become a financial time bomb. Jacques de Rothschild, watching from Paris, immediately understood the danger. On July the 2nd, he sent an urgent memorandum to the French finance minister. The political situation in the Balkans has created conditions under which a local conflict could cascade into a general war involving all the great powers. The ministry should prepare contingency plans for emergency financing and gold reserve protection. The finance minister, distracted by a domestic tax controversy, acknowledged the memo but took no action. He assumed, like most politicians, that diplomacy would contain the crisis. He failed to understand what the Rothschilds had learned over a century of financing European governments. Markets anticipated political events better than politicians did, and when markets started moving defensively, catastrophe usually followed. By the second week of July, those defensive movements were accelerating. London, the first real panic. On July 13th, trading on the London Stock Exchange revealed a pattern that shocked even veteran observers. Massive coordinated selling of Russian and Austro-Hungarian securities. In a single day, Russian railway bonds lost 9% of their value. Austrian industrial shares fell by 7%. The selling was concentrated, professional, and relentless. Institutions dumping positions, not individuals panic selling. Someone with access to significant information was getting out. The Bank of England's governor, Walter Cunliffe, convened an emergency meeting with the heads of London's major merchant banks on July 15th. "What do you know that the government doesn't?" he asked bluntly. The answers were troubling. Multiple sources confirmed that Austria-Hungary was preparing an ultimatum to Serbia, so harsh that Serbia couldn't possibly accept it. Germany had privately assured Austria of support. Russia had mobilized additional troops near its western borders. France had recalled military officers from summer leave. "And if Austria invades Serbia?" Cunliffe asked. "Russia mobilizes," replied a partner from Barings Bank. "Germany mobilizes against Russia. France mobilizes against Germany. We would face the choice of intervening or watching France collapse, which we cannot permit." Timeline? 3 weeks, perhaps 4. Cunliffe absorbed this. "Gentlemen, if you believe a general European war is probable, the bank must prepare emergency measures immediately. A war of that scale would devastate normal commerce, freeze credit markets, and potentially collapse the gold standard. Have your institutions calculated their exposure?" They had. The numbers were staggering. British banks held enormous volumes of German and Austrian securities, Russian bonds, and French commercial paper. General war would render much of it worthless overnight. Moreover, Britain's position as the world's financial center depended on stable international trade. War would shatter that stability. "We should begin liquidating foreign positions," someone suggested. "If we do that," Cunliffe countered, "we'll trigger the very panic we're trying to avoid. The moment London starts massively selling continental securities, Berlin and Paris will know we expect war. It could accelerate the crisis." The room fell silent. They were trapped in a prisoner's dilemma. Acting on their information would make the catastrophe worse, but failing to act would leave them exposed when it arrived. This was the terrible logic of the pre-war financial system. It was too interconnected to allow anyone to protect themselves without harming everyone else. The gold standard under stress, July 16th to 23, 1914. For 40 years, Europe's monetary system had rested on a seemingly unshakable foundation, the gold standard. Every major currency was convertible to gold at a fixed rate. This created stability, facilitated international trade, and forced governments to maintain fiscal discipline. But it also created a rigid system with no flexibility during crises. As July 1914 progressed, that rigidity became a fatal weakness. The mechanism was simple, but devastating. As political tensions rose, individuals and institutions across Europe began converting paper currency into gold, either for safety or to move wealth across borders. This drained gold reserves from national banks. Under the rules of the gold standard, declining reserves forced banks to contract credit and raise interest rates to attract gold back. But contracting credit during a political crisis made everything worse. It strangled commerce, panicked markets, and accelerated capital flight. The system was devouring itself. Austria-Hungary felt the pressure first. Between July 16th and July 23rd, the Austro-Hungarian bank's gold reserves fell by an additional 168 million krone, an unprecedented hemorrhage that threatened the currency's stability. The bank responded by raising its discount rate from 4% to 5%, then to 6% within a week. The higher rates were supposed to attract gold back by making Austrian assets more attractive. Instead, they signaled desperation, which accelerated withdrawals. Russia faced similar pressure. By July 20th, Russian banks in Moscow and St. Petersburg were limiting gold withdrawals to 500 rubles per person per day, an unofficial suspension of convertibility that violated the gold standard's core principle. In provincial cities, some banks simply closed their gold windows entirely, claiming temporary supply interruptions. Germany, with stronger reserves, held steady longer, but even the Reichsbank couldn't ignore the trend. On July 22nd, Havenstein ordered a complete audit of gold stocks and instructed branch banks to monitor foreign withdrawals closely. Plans were drafted, quietly, unofficially, for suspending gold convertibility if political conditions deteriorated further. The Bank of England, sitting atop the world's largest gold reserves, watched these continental developments with growing alarm. Britain's financial system was built on confidence in sterling's gold backing. Any hint that London might suspend convertibility would trigger a global financial earthquake. Yet the pressure was building there too. Foreign depositors were shifting assets to New York. Insurance companies were demanding higher gold reserves against potential war claims, and British banks were hoarding gold rather than lending it. On July 23rd, Governor Cunliffe received an internal memorandum that quantified the danger. If Austria, Hungary, and Russia went to war, continental demand for emergency credit would create massive pressure on Britain's gold reserves through the interconnected banking system. Britain might have to choose between maintaining gold convertibility and financing a potential war effort. The memo's conclusion was stark. The gold standard and a general European war cannot coexist. One will destroy the other. Bond markets. The collapse begins. While gold drained from central banks, Europe's bond markets began experiencing their own catastrophic breakdown. Government bonds, the supposedly safe assets that financed everything from railroads to military expansion, were repricing for war. Russian bonds led the collapse. Russia's enormous military expansion over the previous decade had been financed largely through French and British loans. By mid-July, those bonds were trading at steep discounts to their face value. On July 20th, Russian 5% bonds traded in Paris fell from 92 to 81 in a single session, a decline that wiped out hundreds of millions of francs in investor wealth. The reason was simple. Investors understood that war would destroy Russia's ability to service foreign debt. Military spending would consume all available revenue. International trade, which generated the gold reserves needed for foreign payments, would collapse. Russia might even default entirely. Austrian and Serbian bonds fared worse. By July 22nd, Serbian government debt was effectively worthless. No buyers at any price. Austrian bonds, backed by a much stronger economy, held up better but still fell sharply. What made these declines so ominous was their speed and finality. Markets weren't pricing in temporary volatility, they were pricing in catastrophe. The Bank of France, watching the collapse unfold, faced an acute dilemma. French banks and investors held over 12 billion francs in Russian bonds, roughly a quarter of Russia's total foreign debt. If those bonds became worthless, French financial institutions would suffer devastating losses. Yet France couldn't support Russia's bonds without appearing to finance Russia's war preparation, which would be politically explosive. On July 24th, the Bank of France's governor met secretly with the finance minister and representatives from the Rothschilds, Crédit Lyonnais, and Société Générale. The discussion was frank. Could French banks survive a total loss of Russian bonds? The answer was technically yes, but barely. The losses would cripple lending capacity, trigger bank runs, and potentially force government intervention. And that assumes, one banker noted grimly, that French government bonds remain stable. If France enters the war, our own debt will become the next target for market panic. The meeting ended without resolution. There was no good option, only degrees of catastrophe. The arms manufacturers following the money. While bankers tracked gold and bonds, another group was reading the situation with equal precision, arms manufacturers. And they weren't just preparing for war, they were betting everything on it. The German industrial conglomerate Krupp AG, which produced everything from railroad equipment to artillery pieces, saw a dramatic change in order patterns during July. On July 15th, the German War Ministry requested immediate quotations for unprecedented quantities of ammunition, artillery shells, and rifle components. The quantities weren't for routine military exercises. They implied months of sustained combat. Krupp's financial director, looking at the numbers, immediately understood. The War Ministry was preparing for a long, intensive conflict. He convened an emergency board meeting on July 17th to discuss expanding production capacity. The decision was made quickly. Borrow heavily, stockpile raw materials, hire additional workers, and prepare for the largest military production run in the company's history. Similar patterns emerged across Europe. In France, Schneider-Creusot received massive advance orders from the French War Ministry. In Britain, Vickers and Armstrong-Whitworth began expanding their munitions facilities. In Russia, the Putilov works in St. Petersburg went to round-the-clock shifts. What made this significant wasn't just the military preparation, it was the financing. Arms manufacturers needed immediate capital to expand production before being paid by governments. Banks, recognizing the profitability of military contracts, provided that capital eagerly. Between July 15th and July 28th, European banks extended an estimated 400 million marks in loans to arms manufacturers, loans that would only be profitable if war actually occurred. The financial sector was now invested in catastrophe. If there was a single moment when Europe's financial elite knew war was inevitable, it wasn't a political declaration or a military mobilization. It was the closing of the stock exchanges. On Friday, July 31st, 1914, every major stock exchange in Europe shut down. Vienna closed first, at 10 a.m. local time. The official announcement cited extraordinary market conditions requiring temporary suspension of trading to maintain orderly price discovery. The reality was simpler. The Austro-Hungarian government couldn't allow the market to price in the war it was about to fight. Prices were collapsing so fast that continued trading would have destroyed the entire financial system. Budapest followed an hour later. St. Petersburg closed at noon. Berlin, after desperate attempts to maintain stability, suspended trading at 2 p.m. Paris closed at 3 p.m. By evening, London, the world's largest and most liquid financial market, announced it would not open Monday morning. This was unprecedented. Stock exchanges had operated through wars, revolutions, and financial panics for over a century. Closing them completely signaled something far worse than normal crisis. It meant the entire system of price discovery, capital allocation, and financial intermediation had broken down so completely that continuing would cause more damage than stopping. For bankers and financiers, the closures were a revelation more significant than any military telegram. Markets closing meant governments had concluded that war was certain and that normal financial activity was impossible during wartime. It meant the global trading system, built on decades of increasing integration, was about to fracture along national lines. It meant capital controls, currency restrictions, and economic warfare. Most importantly, it meant that the informal but powerful constraints markets normally imposed on governments, the fear of capital flight, currency collapse, and investor anger had been suspended. With markets closed, governments were free to borrow, print money, and seize resources without immediate financial consequences. War was now inevitable because the financial system had stopped functioning. The emergency measures cascade. The exchange closures were merely the most visible element of a broader financial breakdown. Behind the scenes, central banks and finance ministries were implementing emergency measures that transformed Europe's economy overnight. The Bank of England, moving faster than any other institution, issued emergency fiduciary notes on July 31st, paper currency backed not by gold, but by government securities. This was a de facto suspension of the gold standard, though officials carefully avoided saying so. The new notes allowed the bank to inject liquidity into the financial system without draining gold reserves. Within 48 hours, over $100 million in emergency notes entered circulation. The Banque de France took similar action, suspending gold payments for notes under 100 francs and issuing moratorium decrees that allowed banks to delay payment on commercial obligations. These measures prevented bank runs, but also froze the normal flow of credit through the economy. Businesses couldn't collect payments owed to them, couldn't make payments to suppliers, and couldn't obtain new loans. Commerce ground toward paralysis. Germany, Belgium, and Austria-Hungary implemented even more draconian controls. Currency export restrictions prevented capital from fleeing the country. Gold requisition orders allowed governments to seize gold coins from private citizens for the national emergency. Banks were authorized to refuse withdrawals exceeding certain limits. These weren't temporary crisis measures. They were preparations for total war economy. Russia went furthest. On August 1st, the state bank suspended all gold payments, effectively abandoning the gold standard entirely. The ruble became what economists would later call fiat currency, paper money backed only by government decree, not convertible to gold at any price. This gave Russia unlimited ability to print money for war financing, but it also meant the ruble would likely collapse in value as the war progressed. What the public didn't know. While newspapers focused on diplomatic negotiations and military movements, few ordinary Europeans understood the financial catastrophe unfolding in parallel. The closures and emergency measures were presented as prudent precautions, temporary stabilizations that would be reversed once tensions eased. But the bankers knew better. On July 31st, as exchanges closed across the continent, the same financial elite who had predicted war now calculated its costs with chilling precision. At the Banque de France, analysts estimated that France would need to borrow at least 15 billion francs in the first year of war, roughly equivalent to 3 years of normal government revenue. At the Reichsbank, estimates for German borrowing ran even higher, 20 billion marks or more. These weren't abstract figures. They represented bonds that would need to be issued, interest that would need to be paid, and inflation that would erode savings. They represented a transfer of wealth from ordinary citizens, who would see their purchasing power decline and their taxes rise, to financial institutions that would profit from the emergency. In London, on the afternoon of July 31st, a senior partner at Rothschild's summed up the situation in a private conversation. The governments are about to borrow sums that would have been inconceivable 6 weeks ago, at interest rates we can dictate, with repayment terms extending decades into the future. This war will be the most profitable event in modern financial history. He wasn't celebrating. His tone was somber, almost haunted. But the analysis was accurate. Return to the boardroom, Reichsbank, Berlin, August 2nd, 1914. The same room, the same men. But the world outside had changed fundamentally. Germany had declared war on Russia on August 1st. On August 2nd, German troops crossed into Luxembourg, heading for France. The war that the bankers had predicted with such cold precision was now reality. Rudolf Havenstein reviewed the initial financing requirements from the War Ministry. The numbers matched their earlier projections almost exactly. 5 billion marks immediately, with expectations for sustained borrowing throughout the conflict. The Reichsbank and Germany's major private banks had already agreed to syndicate the first war loan at 5% interest, a rate that would generate enormous profits while still appearing patriotic. "The Kaiser has approved our terms," Havenstein announced to the assembled bankers. "The first issuance will be 500 million marks, with subsequent tranches monthly. We are authorized to expand note circulation as needed to maintain liquidity." Translation: they could print money to finance the war, knowing that inflation would make the government's debt easier to service while destroying the savings of ordinary Germans. The profits would be real. The costs would be distributed across millions of people who had no voice in the decision. Franz von Mendelssohn reviewed projections for bond trading once exchanges reopened. "Austrian and Russian bonds will be worthless in France and Britain," he noted. "German bonds will be worthless in Paris and London, but domestic markets will absorb war loans readily. Patriotism and coercion will ensure demand." Another banker added figures for expected profits from foreign exchange arbitrage. With currencies no longer convertible to gold and capital controls fragmenting international markets, opportunities for profitable currency trading would explode. Banks with international connections, banks like theirs, could exploit price discrepancies between markets. The profits from lending to governments, underwriting war bonds, and trading disrupted currencies would be staggering. Early estimates suggested returns exceeding 20% annually for the duration of the conflict, rates unthinkable in peacetime. The moral complexity. What made this moment so deeply troubling wasn't that the bankers were evil conspirators who wanted war. Most didn't. Many genuinely hoped for peace, feared for their sons who would fight, and understood the human catastrophe about to unfold. But their professional training, institutional incentives, and fiduciary responsibilities to shareholders created a terrible logic. Once war became probable, their duty was to position their institutions to profit from it. Failing to do so would be financially irresponsible. Their competitors would gain advantage. Their shareholders would suffer unnecessary losses. The system rewarded those who anticipated catastrophe and punished those who hoped for the best. Over decades, this had created a financial elite that was extraordinarily skilled at reading danger and positioning for profit, but had no mechanism for preventing the disasters they predicted. They were like seismologists who could detect an earthquake weeks in advance, but lacked any way to stop it. Their only rational choice was to make sure they were standing on solid ground when it hit. Havenstein, looking around the room at his colleagues, felt the weight of this contradiction. "Gentlemen," he said quietly, "we have done our duty to our institutions, but I want each of you to understand what that duty has cost. The loans we issue will finance the deaths of millions. The Bonds we sell will be paid for with the labor of generations yet unborn. The inflation we enable will destroy the savings of widows and pensioners. We will profit while Europe burns. No one disputed this. They all understood. And yet, Havenstein continued, if we had refused, others would have taken our place. If German banks had declined to finance the war, the government would have commandeered our gold reserves and printed currency without limit, creating even worse destruction. We are trapped in a system we did not create and cannot control. This was the final, terrible truth. The financial mechanics of modern war had become so complex, so interconnected, and so powerful that they operated with a logic independent of human will. Bankers could predict war, profit from war, and suffer moral anguish about war, but they couldn't prevent it. The hidden history. In the century since 1914, historians have analyzed World War I's causes exhaustively. Nationalism, imperialism, militarism, the alliance system, the arms race, the Balkan crises. All these factors mattered, but largely absent from popular histories is the financial dimension, the way money flows, credit markets, and banking systems both predicted and enabled the catastrophe. The men who understood the coming disaster weren't diplomats stammering through failed negotiations, or generals confidently predicting quick victory. They were bankers, sitting in private boardrooms, reading telegrams about gold withdrawals and bond prices, calculating interest rates on money that hadn't been borrowed yet for a war that hadn't officially started. They knew first because their instruments were more sensitive than political analysis. Markets don't lie. When capital flees a country, when gold reserves drain, when bonds collapse, something fundamental is breaking. The bankers of July 1914 read those signals with the same certainty that doctors read vital signs in a dying patient, and they prepared accordingly. The war loans they arranged in advance, the emergency notes they drafted, the currency controls they designed, all were ready before the first shot was fired. The financial architecture of World War I was built in July 1914 by men in dark suits calculating returns while Europe slept. Between 1914 and 1918, European governments would borrow over $200 billion in period currency values to finance the war. The interest payments on that debt would burden Europe for generations, contributing to the economic instability that enabled fascism in the 1930s. The inflation generated by money printing would destroy the savings of the middle class across the continent, and the bankers who arranged those loans, who created that inflation, who profited from that catastrophe. Most remained wealthy, powerful, and influential after the war ended. Some lost money as currencies collapsed and governments defaulted, but as a class, they survived better than the millions who died in trenches, or the millions more, who died in the famines and epidemics that war enabled. The final frame. On August 3rd, 1914, Britain declared war on Germany. The conflict that began with an assassination in Sarajevo had, in just 5 weeks, engulfed the entire continent. Over the next 4 years, 10 million soldiers would die. 20 million would be wounded. Countless millions of civilians would perish from starvation, disease, and violence. But on that August morning in Berlin, in a smoky boardroom where men in dark suits studied ledgers and bond tables, there was only quiet satisfaction at predictions proven correct and preparations that had been adequate. They had understood before the politicians. They had acted before the generals. And when the catastrophe they predicted arrived on schedule, they were ready to profit from it. That is the hidden story of July 1914, the month when Europe's bankers knew war was coming, calculated its costs, positioned themselves to gain from disaster, and then watched as the world they had predicted and helped to finance tore itself apart. The first casualty of World War I wasn't a soldier. It was the illusion that finance and war were separate spheres, that money was neutral, that the men who controlled credit had no hand in catastrophe. By the time the guns fell silent in November 1918, that illusion was dead. But by then, so were millions of men who never understood that the war had begun, not with mobilization orders or declarations from chancelleries, but in the quiet calculations of bankers who saw opportunity in apocalypse. The mathematics of war had preceded the reality of war, and the profits were calculated long before the corpses were counted.